And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, honoured by the 2025 Salter Awards. Good evening. Welcome to the programme. I'm Stephen Grootes. Good to have you along. Well, yesterday we were telling you about the appointment of Mcebisi Jonas, a former Deputy Finance Minister, among other things, big corporate roles at MTN, other places as well, of course. And he has now become the special envoy to the United States in one of those jobs where actually maybe a little bit thankless if you think about it. I mean, you're just sort of asking for trouble if you represent South Africa in Washington at the moment, as he is clearly going to do. Then overnight, various comments that he did say back in 2020, they weren't particularly polite about the US President Donald Trump, including the fact that he called Trump a sort of racist homophobe, a narcissist. And you'll hear from Mcebisi Jonas in just a moment about how he feels about those comments now and what the point of them was, and also how he understands his role. I do want to say, though, before you hear that conversation, I don't know how many South African politicians you would find who haven't said something bad about Trump. I mean, I can think of a few, but most of them probably have said something. And, you know, I could actually be speaking about most of the Republican Party when I say that, because most of them have said something pretty disparaging or unkind, possibly true or not, depending on your point of view, about the current US president. So there's a lot to look at here. Anyway, you'll hear Mcebisi Jonas in just a moment. I was fascinated by a story doing the rounds, and it came, I think, out of an investment call yesterday around Mediclinic. They're going to freeze non-essential hires. They think artificial intelligence can do some of those jobs. On one level, I buy some of the hype around AI. I do worry that so many people say so much is going to change, and people have always said that, you know, when radio comes, no one will read a newspaper. I suppose that's sort of true. When TV comes, no one will listen to the radio. When phones come, no one will listen to the radio or watch TV. These things are sort of true and sort of aren't. So I don't know. I also am a little cynical around what AI can do right now. And underneath all of that, if you don't have a job, you cannot provide a market for a service. So what's the point? So, I mean, what's AI going to sell things to? Who's going to provide a service for if no one has any income? So, I mean, there are lots of things to look at. Anyway, we'll talk about that in just a moment as well. I think that could be quite an interesting conversation. Good to hear from you tonight. 011 883 0702 021 446 0567. And, of course, voice notes this evening on 072 702 1702.
The Money Show
with Stephen Grootes.
Well, yesterday you would have heard the confirmation from the presidency that President Cyril Ramaphosa has now appointed Mcebisi Jonas as a special envoy to the US, essentially, I suppose, to discuss trade issues with the Trump administration. And then, overnight, both South African and then particularly American outlets reporting Jonas had referred to Trump as a racist homophobe and a narcissist. This was all back in 2020. He was actually delivering a lecture. And, of course, if you go into the recent history of our relationship with the United States, you'll see the name of Ebrahim Rasool, and he was declared persona non grata for comments he made about Trump. Well, the special envoy to the US, Mcebisi Jonas, is with me now. He's a former Deputy Finance Minister. You'll remember his history during the Gupta era, what he stood up to. You'll remember as well, of course, everything else that he's done since then. He joins us now. Mr. Jonas, good evening, and thank you so much for joining us this evening.
Good evening, Stephen.
You're a special envoy, so you're not an ambassador. What do you understand your role to be in all of this?
I guess, you're right. The special envoy is not an ambassador. It is somebody appointed to represent the president and government on specific issues. It could be economic and trade issues. It could be cultural issues. It could be resolving conflicts in some instances. But it is very specific and limited in terms of time and focus.
So is this specifically about trade?
It is. It covers. If you would have seen the announcement, it covers political, trade. It covers economic, broadly speaking, and it deals with all of the other dynamics and cultural issues of difference between South Africa and the US. I guess you could also look at it as a mechanism to use to kind of ease the environment for good diplomatic relationship between South Africa and the US, and they have paved the way for a more permanent appointment of an ambassador, as it were.
It's a tough job to represent South Africa in the United States right now. You have other jobs. You're chair of MTN, chair of a platinum mining company. Why would you take this job?
Look, I mean, look at it in multiple ways. On the one side, I think the U.S. relation with South Africa is fundamentally important to the national agenda for South Africa. It is important for our economy. It has also a history, so to speak. But also it's important for our relationship with other parts of the world. So look at it as part of, if you like, a broader economic, social and cultural agenda of the country. In that sense, I think it's crucial. So it is really, for my part, contribution to driving national interest, so to speak. So that's the only purpose, really, if you ask my opinion.
I mean, all the people you're going to see now in the US, they all come from one party, and they all come from a party that supports the President Donald Trump. And back in 2020, you delivered the Ahmed Kathrada Memorial Lecture in that year. You described Trump as a racist homophobe, as a narcissistic right-winger. Now you have to deal with the Trump administration. Can you still deal with that?
I guess, I mean, and I must put that in context, because, I mean, at the time, I was outside of government. At the time, I was speaking as an activist, and I think these things happen. I mean, people move on. I mean, and confront the challenges of the time. I mean, I'm sure if you Google any politician has said something nasty about one other politician or the other, but the reality of the matter is that the challenge that we all face and the task at hand, it is to work on the relations between the two countries. And I think, I mean, firstly, I'm committed to doing that. But secondly, I think I've got the backing of government initially, but also of South Africans in general.
It's a tricky one. I mean, there are plenty of American politicians who now work with Trump who've said pretty bad things about him, and they've all had to sort of beg forgiveness or had to pledge allegiance or something. I'm no expert on American politics. It seems to me that they've done that. I mean, it seems to me he's looking for reasons to pick a fight with South Africa.
I wouldn't. I guess, I mean, let's accept that, I mean, our relations, the nature of South African relations and the souring predates the Trump administration. Because I think we must not make the mistake that most of the problems we have started suddenly with the Trump administrations. Most of the issues, whether are issues of trade, whether they are kind of economic relations issues, or whether to overlay that geopolitical issues, all of these issues predate the current administration in the US. So in a sense, therefore, I think it has been something that South Africa has been engaged with for quite some time. And my task is to kind of understand what grounds have been covered, what has not been covered, what are the blockages, and also to understand the thinking from the other side so that we can frame our responses appropriately to deal with the challenges, so to speak. I mean, we believe, and I'm a believer, that the world is for all of us, and we must find commonalities and areas where we could work and strengthen the commonalities to achieve a greater good. And I think it's possible to do that.
So, I mean, a big part of me wants to believe that that is true. But we know Trump holds grudges. He got a British ambassador fired because of something he had said. Do you still think it will be possible to actually do the job when, I mean, it's Breitbart News in the US, they're right-wing, support Trump. They were the ones who publicized the Ibrahim Rasool comments, etc. They're the ones running with it today.
Look, I'm not underplaying the challenge. The situation is complex, not because of what I said, but by its very objective nature, it is complex. And I don't think there are quick wins in it. I think it's a long slog where we kind of rebuild understanding and find each other on a number of areas, as it were. And I think there is basis for doing that. I think we've got in South Africa more than 600 companies from the US operating in South Africa. We still have a trade balance that is positive for South Africa. And so all of those things point to the fact that the basis for a long-term relationship is there. I mean, it's a matter of us working and dealing with some of the problems and challenges we have gone through over the past.
International relations and relationships between countries should be just that, relationships between countries. In some ways, our conversations with the United States have become personalized. Plenty of people in South Africa have said, plenty of Americans have said bad things about that.
I would argue, Stephen, that politics in general across the world have been over-personalized, and in South Africa for that matter. I mean, in South Africa we still say we went through the Mandela era as if everybody didn't exist in that period. We went through the Thabo era as if nobody existed in that period. We went through the Zuma era. That actually shows essentially there's always a tendency to over-personalize politics. The reality, though, is different. There is complexity. There is multiple personalities influencing the direction of where things go. And it does require, I think, for those who work in the policy space, for those who are negotiating, very sharp focus on what they are doing and understanding and patience to be able to get over the challenges they face.
I don't know if you've had time yet. I mean, this announcement is just 24 hours, 30 hours old now. Have you been able to speak to any people in the US to get their reaction to your appointment, to South Africans as well?
Look, at the moment, I think we're taking an approach that a lot of traffic from South Africa to the US has happened, and a lot of traffic from the US to South Africa has happened. I think our focus at the moment is to gather what are the key issues emerging out of that. And in a sense, also get a sense of what the thinking is within the presidency and the ministers and so on, government in general, and also business across the board, so that we consolidate our approach to the issues as we move ahead.
Okay, so obviously it'll be interesting to see. You're not in the US just yet. You're going to be quite careful about that, strategize a little bit. Things are moving so quickly in the Trump era that maybe you don't want to rush.
We are in touch. With the developments in the US. We get constant briefing about the development. We are engaging at some level, but the point I'm making is that I think our primary task is at the moment to frame and understand what has been happening, but also to frame our approach to it. So that's I think our focus, so to speak, and also to build capacity. Because I think to do the job, I think it's not a one man's job, but I think we need to start building a capacity that can enable us to execute on the task that we have been given by the president.
One of the problems that I'm sure you're going to have is what I, as a South African, see disinformation about our country in the United States. That's become a big issue. It could be quite tricky to just get people to accept what the real facts are, that actually land isn't being taken without compensation, things like that. In other words, there's a lot of kind of groundwork, I suppose, an unfortunate thought maybe, but, there's a lot of sort of behind-the-scenes work that's going to have to be done before any progress can be made, it would seem to me.
Already that work is happening already, I think, clarifying those issues and etc. But again, ultimately, I think as they say, the pudding is in the eating. I guess when people start interacting more, you have bilateral traffic increasing at an official level between the two countries, and I think there will be an understanding, an enhancement of understanding. But fundamentally, though, for me, is the unity of South Africans around these issues. Because I think if South Africans are so divided, and I think that's part of the work that I think is happening at home at the moment, to try and find some common ground for South Africans and commonality of purpose and views. There's a saying that I think nations should have their differences ending at their shores. And I think sometimes South Africans carry them across the shores. And that's, I think, that we need to manage as we go along.
It looks quite difficult. If you looked at other countries trying to deal with the Trump administration, Canada is fighting an election on this very issue. The Mexican president, also relatively new in her term, suddenly dealing with all of this. I don't know what's going to happen. We had tariffs imposed last week, and then suddenly there was the tariff pause. How does a country like ours, a diverse country that is in our constitution actually the very embodiment of diversity, equity, and inclusion, as the Americans call it. An economy like ours, an open, medium-sized economy, how do we navigate what's going to be quite a difficult period, I think, in global history?
Look, I simplify things sometimes. Because I think if you think about it hard, jobs are important for everyone, irrespective of your ideological orientation. Good education and good schools, they don't require ideology. Good health, public health system doesn't require ideology. And to have jobs and all of these things, you need revenue. Revenue is a product of a very good trade balance, as it were. So no matter where you're coming from, there is a baseline. That baseline goes beyond identity politics. It goes beyond race. It goes beyond cultural orientation. A job is a job, and everybody wants a job. Growth is growth, and it has to happen. And I'm saying sometimes I take a view, and particularly because South Africa is in coalition government now, in a government of national unity, actually, again, showing us that ideology in itself doesn't pay the bills. So there's something else that you have to do. You have to grow the economy, and you have to go and engage investors. You have to do all sorts of things to ensure that the economy is healthy. And that's the practical approach I take, to be pragmatic. The time, I think, for ideology is increasingly rescinding, I would argue.
It's a very interesting comment. Mcebisi Jonas, Special Envoy to the United States, particularly on matters of trade and the economy. I really appreciate your time tonight on The Money Show. Thank you very much.
Thank you very much.
702.
702.
Stephen is on X.
At Stephen Grootes.
Well, I'll be interested in your views about that, particularly, obviously, the stuff that he said about Trump there. We're all going to have different views about that. But also, towards the end, when he said it's not a time for ideology, we need to be pragmatic. How many South African politicians have you heard saying that recently? Not very many. And often the arguments that we have are all about ideology, and they're all about other things. So I don't know if we're seeing the birth of something new here, but certainly I thought that was a very important comment by someone in a very senior position and now playing a senior role, difficult role. I thought that was very interesting, the idea that we should sort of do away with ideology. Mcebisi Jonas, that conversation for you, of course, available as a podcast as well.
The Money Show.
The markets.
Anthony Modesani, of course, is a senior equity sales trader at Absa CIB. Anthony, good evening to you. The US President Donald Trump, another day, another comment about tariffs. He sort of suggested he was going to pause tariffs on what they call the auto industry, what we call the car industry. And that really set the tone for much of the day for everyone.
Yeah, Stephen, thanks. Good to be here once again. It's just been tariffs here, tariffs there, and then, you're finding the administration having to walk back some of their comments and do a bit of thinking around that. So, that's provided a bit of a positive impetus for the market. We've started this week on the front foot globally. You've seen gains of around 1% to 2% depending where you look. And the market's just sort of taking it in stride at the moment.
People finding, our share price is finding a little bit of support. I just get a sense of there's been so much volatility. Everything's a bit tentative. If there's bad news, a share gets hit hard, much harder than it would in normal times. If there's a little bit of good news, that share goes up much more than it would in normal times.
No, absolutely. So I think last week, I can't even find the right adjectives to describe it, but it was pretty crazy. You just saw like indiscriminate selling across the board, and then you just found support towards the back end of the week when you sort of walked back the comments around tariffs and you had the reprieve. And, the market's just sort of trying to find a level, and it does seem like, okay, now we're getting to a point where we know how to speak Trump, right? So that's it's understanding how he thinks and how he behaves, and, understanding the implications from there. And China and the US have sort of gone sort of as far as they probably can go for the time being. And we'll just monitor how that relationship plays out. As far as our market's concerned, we saw like we were averaging around 40-odd billion trade per day last week. That's simmered down now into the 20-odd billions. That's back to like our normal levels of trading. It is a short week as well. We have recouped quite a bit of that losses if you look at the index for over that time period. I think that what you probably saw is that you saw some of your biggest sort of long onlys come in and buys this cheap, the good quality defensive names into that weakness. But we always just a comment away from another sell-off, right?
Well, this is the thing. Okay, so he's walked back pretty much. There are still tariffs, quite a high level of tariffs historically. But apart from China, things are much more normal. Well, much more normal than they were, Anthony. I don't know what that means. But the problem is that this is now a new normal. Actually, we have steeper tariffs going into the US than we did before. And suddenly that's become just acceptable.
Yeah, it's the markets are quite fascinating that you learn to adapt, right? And it's always fast moving. So, we know that there's going to be a bit more inflation coming through from these tariffs. And what does that sort of mean for global growth? So global growth is going to slow over time. So, it's trying to sort of figure its way out from here. I think like last week, the past 2 weeks, chaos couldn't just continue indefinitely, like world can't function like that. But yeah, it's quite a lot, and I think everyone's welcoming an Easter break at this point in time and to looking forward to a breather.
There were some comments today from the Reserve Bank. I think it was a policy review, a document they put out, suggesting international interest rates will be higher for longer. I mean, that surely means ours will too.
I think when he said international, he meant ours, actually. Yeah, so he just said that there's risks to inflation, new risks that have emerged, and he sees upside risks to inflation at the moment. So it doesn't look like we're going to get any cuts anytime soon, unfortunately. We did see the rand sell off towards the back end of our session post those comments. Obviously disappointing as a South African consumer. I think we could do with the relief, and I think inflation has been pretty well anchored at this point in time. So, but I mean, we know Lesige, he is very hawkish, so not surprising in that sense.
Yeah, I mean, I suppose you would actually expect, when you look at the volatility we had, I mean, this is going to be looming in the minds of central bankers for a long time to come everywhere, including the US Fed. I mean, they've got other problems to worry about too.
Yeah, I mean, they've had a dual mandate. They've got to worry about what happens if your unemployment starts to tick up, and then obviously we've discussed the inflation that might start.
And if Powell gets fired.
I think Trump said he'll leave him alone for now at this time being, so we'll see what happens there.
Anthony Modasani, thanks very much indeed. Senior equity sales trader at Absa CIB, bringing the time to 6:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, good to hear from you this evening. I don't know how you feel about this. There's a story today that American Airlines, they're obviously a big carrier in the United States, they're now going to offer basically free Wi-Fi to all passengers on most domestic flights. And I know there was a time, I think it was Kalula, no longer with us, I suspect, who actually gave you Wi-Fi on a plane. You had to pay for it, and I know many international flights do it. But I do wonder about the sort of experience of everyone having Wi-Fi whenever you get on a plane. I have to say, I find, especially in the sort of late evening, you've had a hard day, a lot going on, you're on the way back home from wherever, the idea of slipping into a seat and having no one being able to bug me for 2 hours, from Joburg to Cape Town or the other way around, is great. I mean, isn't that just bliss? You put your headphones on, you watch a movie or whatever it is, listen to a Money Show podcast, and no one can interrupt you. And when you land and people say, did you do this, did you do that? You can say, no, but I couldn't. I had no connection. Now, and you're going to get on one of these planes, and it'll happen here eventually because, there'll be Starlink eventually. And it's going to be this, it's going to be that. WhatsApp's going to keep going ting, ting, ting. You're going to have people answering the phone next to you. I mean, really, I'm not so sure. Kind of the last place on the planet where you can be free of a phone. And I can't help but feel it's been taken from us.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, during the last few days of market volatility, there's been quite a few shares that really have stood out on the JSE. Generally speaking, they've been strong, sort of consumer-facing companies. So TFG, the fashion group, Mr. Price, and of course Capitec as well, one that you would expect in some ways. And on one level, it's not surprising, but it's very interesting to see who does well in these times and who doesn't. Hannes van den Berg is the head of SA Equity and Multi-Asset at 91. Hannes, good evening. Really appreciate the time. I mean, so much uncertainty, volatility at the moment. What is it about these shares, these companies that are standing out for you?
Yeah, good evening. Thanks for having me. We are in a time where fear and greed are driving share prices more than anything else. I mean, if you're in a period like this, I often compare it to where we were in COVID, when we went through all of this uncertainty. People weren't sure when we were going to go back to normality, back to the shopping mall, our office, or when we were going to get a vaccine, and if and how the vaccine was going to work. It's pretty much the same as we have with tariffs now. People don't know where this is going to end. Is this all negotiations, or is it really going to be this extreme? If you listen to what the politicians and their advisors are saying, these companies that you've mentioned in the South African context and in the South African environment have gone through terrible and tough times in 2023 and into 2024. I mean, we had to deal with load shedding, port disruption, Lady R, a lot of high interest rates, consumer and confidence uncertainty. And where these companies are now, our view is that we are at a cyclical low in GDP growth for South Africa. I mean, we come from below 1% GDP growth this year, even though we've got all the tariffs and global uncertainty and a new world order to a certain degree establishing itself. GDP growth for South Africa is going to be above 1%. So it's higher than where we were in 2023 and 2024. And our interest rates are lower. You know, we've already had a few interest rate cuts, and people forget that we have got lower fuel prices. Oil price where it currently is, and there's a further cut on the cards in April. So even though it doesn't feel like it for most of the consumers out there, the likes of Capitec, Mr. Price, businesses that operate well, that execute well on their strategy, the fundamentals of those businesses still look quite good and healthy and strong. And as I say, are at a cyclical low and of a very depressed base when it comes to earnings.
I mean, it's interesting. It's two sort of clothing retailers and a bank. I mean, yes, they're companies in a strong market position, but they also provide essentials, things you can't do without.
Yeah, if you analyze the consumer wallet, which we spend quite a lot of time doing, and you say inflation is 4 or 5%, people will know what their wage or their salaries were increased by. A low single-digit number, and you add to that the fact that tourism is doing quite well. The number of ships in the Cape Town harbour just keeps on increasing from one year to the next, and that spending, as well as services in the economy, together with construction and also in the financial services sector, you're seeing more and more people getting employed. So you saw in the third and fourth quarter of last year the more jobs being created in the South African economy. Not as many as we want, and we still need a lot more. But if you add the inflationary increase, a few more people that are entering into the job market, there's you can say 5-6% increase in the overall South African consumer wallet. On the other side, on the expenses side, as I've mentioned, fuel prices are lower, and post the interest rate cuts that we've seen, your interest expense have gone backwards. So it's what you paid last year versus this year. It's a negative number. So if you build the consumer wallet, our numbers actually show 7 or 8% increase in the ability to spend. Obviously, different LSMs have got different outcomes, more exposed to food, less exposed to food, more exposed to debt and interest rates, etc. Some exposed to taxi and taxi fares versus others driving with their own car. But overall, our view is that the consumer wallet has grown somewhere between 6 and 8%, closer to 8%. And that means that there's slightly more purchasing power for the likes of some of these, what we call cyclical retailers in the clothing space, and those with unsecured debt that have got exposure to Capitec, and you can take the argument further in some of the other banks and into other retailers.
It's interesting because it wouldn't necessarily be your first thought that at this moment people have a bit more money to spend.
It doesn't feel like it, eh? It doesn't feel like it if we read all the headlines globally, and if you look at what's also happening in the South African political environment. Look, I've got a lot of friends who are in the farming game, and I often joke with them. I haven't met a lot of farmers that will outright in the first paragraph tell you it's going well. South Africans like to complain. Farmers always say that there's not enough this or not enough that, and I say this with the greatest respect. It's a tough industry to be involved in, but overall that sort of same mindset goes to a lot of South Africans. We like to complain, and if you compare what's going on in our political environment versus what's going on in various other countries and in economies, we actually don't look that bad. So it doesn't feel like it. But the South African consumer, and if you look at level of indebtedness and sort of approval rates, etc., if you speak to the banks and you look at non-performing loans, the outcome from an economic and from a consumer perspective is better, definitely, than where we were last year and the year before.
How much rests on what happens over the next few months? I mean, I can't tell you what's going to happen with tariffs. You might have actually seen the worst of it if you think about it. But there was a signal today from the Reserve Bank that actually interest rates may not go down further, and you can understand why they would make that decision. I mean, that surely is a factor in what you're suggesting.
Yeah, they came out with a statement that, or sort of the conclusion of it is that rates will remain higher for longer. The risk to the South African CPI and inflation rates it sort of keeps them at bay at this stage. And I guess they're just following what's happening globally. We are, the way I think about tariffs is almost in three phases. We are in the phase where nobody really knows exactly how it's going to play out. We're all trying to figure it out and run the numbers. What does this mean for trade? What does this mean for growth? What does this mean for inflation? And we are probably in the period of the most uncertainty. Post that period, we'll get more clarity, and there's a 90-day freeze now. So hopefully in the next, let's say, 2 to 3 months, we'll get a better understanding of what this means, and we'll be able to model it and get a clearer picture of how these probabilities play out and have a realistic view of what the world looks like and the cycle to follow. And that's probably what central banks are also doing. The scary word transitory got mentioned again by the Federal Reserve. Now, we heard that word just after COVID when they said inflation will be transitory, and it unfortunately wasn't. Now they're again saying that tariffs and the impact of that might also be transitory. So let's see whether that holds this time around. But I guess it's fair to say the tariffs is essentially a tax. The tax that the US are now negotiating or imposing will have a slowdown effect. And we will go to the phase where we do the numbers, we understand how this plays out. Reserve banks will be in a position where they can more clearly form a view of what inflation and growth expectations will be in the foreseeable future. And then we will continue on the path of potentially further interest rate cuts in the US. And we see the ECB seem fairly front-footed about their cutting program. And our Reserve Bank will probably follow. So we still think 1, maybe 2 cuts of interest rates in South Africa between now and the end of the year. But we need to get through this period of heightened uncertainty that we're experiencing now.
Thank you very much indeed. Really appreciate it. Hannes van den Berg, Head of SA Equity and Multi-Asset at 91.
702. Stephen is on the Money Show.
6 to 8 p.m.
Well, an interesting update today from the coal producer Exxaro. I say coal, they do energy and other things as well. They're very involved in all of that. Suggesting, in fact, that there might still be quite a lot more demand for coal, particularly because, yes, you know who, the US President Donald Trump is disrupting the sort of transition to more renewable energy. On one level, he absolutely is. But I think it's important to remember the economic case for making a change hasn't changed in any way. Now, Texas is getting a huge amount of its electricity from wind and particularly solar power. So now is the UK, and that's because of the economics of it. And the fact is that sun, once you've made your solar panel, sunlight is free. The same for wind. You just really have to do maintenance. So I understand the thought process, and I think they must be right. In the short term, the demand for coal will be higher because Trump is president and someone else is not. But I think in the long term, it would seem to me, from what I understand, the economic case for renewables is convincing. And I can't really see that changing no matter who sits in the White House or what they had for breakfast this morning.
The Money Show, Stephen Grootes, is brought to you by Absa CIB, honored by the 2025 Salter Awards.
Well, the market turmoil of the last few days having a big impact in different sectors, and it's tempting to put every sort of market movement on that. But an interesting update from the luxury goods company LVMH today. They reported lower than expected sales in the first quarter of the year, so that would be before the Trump tariffs. Its share price then plunged down 8%. As a result, it found it was no longer the most valuable luxury goods company in Europe. It was overtaken by Hermès, but it is an indication of some trouble, it would seem, in the luxury goods market. Evan Walker is portfolio manager at 361 Asset Management. Evan, good evening. Thanks for the time. If you look at market volatility, that's one thing. I think the real problem in the luxury goods market, obviously, is that people are predicting a recession in the US and perhaps some other places.
100%, Stephen. Yes, good evening. I mean, this follows the trend, just a wealth trend. Obviously, we've seen markets come off. We've seen Bitcoin come off. We've seen, obviously, quite a lot of pressure, specifically in the Asian markets, China, from a wealth effect, a little bit of a dip in housing prices, etc., through the latter part of last year. And I think just obviously a consumer confidence number globally coming into this first quarter now. We saw a bit of a dip off, and that's sort of ramifications coming through. But just to put it in context, LVMH delivered 14 euros of earnings in 2019, and by 2023, those earnings were up 130% over 4 years. So quite a phenomenal growth rate for this business over 4 years. I mean, stellar growth rate, an unbelievable business. following on obviously the strong global markets and all the dynamics going with it, and obviously following in the footsteps of cryptocurrencies, etc. You saw really, really stellar results from LVMH up until now, and a little bit of a detour in that trajectory.
I mean, it's one thing to spend money on a car. If you need a car, you'll go and find one. To spend a large amount of money on a handbag, you might buy it because it gives you confidence, it makes you feel good. It's a status symbol, really. There are other ways to do that without spending thousands of dollars on a fashion accessory. I mean, this is what makes these companies so vulnerable.
Stephen, it's a very different. It's consumer psyche. It's just certain people in certain regions of the world. I've already got a car. I've already or can't own a car. Can own other things. Everyone buys something for a different reason. It's very hard from a consumer psyche aspect, to distinguish, who pays 8,000 to 10,000 euros for a handbag, and you can pay up to 50,000 euros for a Hermès handbag. And then you can go to Richmond, different parts of the Richmond, luxury goods, and pay up to 600,000 euros for a bracelet or a brooch. So depending on where the wealth spectrum you sit, Stephen, as to where you want to spend money in this day and age. But one thing we do know, per capita incomes globally are rising, and obviously a certain wealth effect comes along with it. But a bigger driver is definitely markets and the propensity for them, what we've seen in the last couple of years, and the spin-off effects coming through markets into luxury goods.
Are some luxury goods companies better placed than others, especially if there are tariffs? I mean, do some maybe have more production facilities in the US?
Not that I know of. They all move around the world and produce, as we know, with companies producing the best jurisdictions. Obviously, a lot is still Eurocentric. A lot of their brands are Eurocentric. They are made in the likes of Italy, etc. So at the onset, no, it doesn't look like it to us. It looks like there could still be pressure from tariffs. These products are quite hard to distinguish. They're such high margin businesses that they can probably absorb quite a big portion of the tariff, depending what the finality of these tariffs are. No one knows at this point where they're moving. But these are strange businesses, Stephen. People actually aspire to pay more. It's quite a ridiculous sentiment, but it's just a business that, if you move a handbag from 8,000 euros to 9,000, doesn't necessarily mean that you sell less. It's just more a consequence of what markets are doing and overall wealth effect, and how many merchant bankers have made $1 million bonuses in the prior year.
Evan Walker, thank you so much. Really appreciate the time. Portfolio manager at 361 Asset Management. Just telling you how the other 5% live, I suppose, in some ways. On the other hand, of course, these companies are bellwethers for very important movements that we're seeing in the economy. We'll talk about Sasol and gas in a moment, talk about what's happening across our continent, and then Warren Ingram this evening. How to survive, how to make your money survive when the politicians are behaving badly. Unfortunately, we only have half an hour for him. You're with The Money Show, 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, honoured by the 2025 Salter Awards. Good evening. Welcome to the second hour of the programme. I'm Stephen Grootes. Well, interested in your thoughts about what Mcebisi Jonas said and how you deal with the US President Donald Trump. I mean, one of the issues you're going to have is that there's sort of no leverage outside the Republican Party. And let me be clear, and this is a political statement that I, Stephen Grootes, and no one else is necessarily making, is that the Republican Party gives the impression that it is just in the thrall, almost like a cult, of Trump. In other words, it's all about him. If you look at sort of, the coverage of his cabinet ministers all meeting, and they all spend time talking about how great he is. It's a bit like reading the public statements of a particular political party here in South Africa. And it doesn't really help anyone when you tie something to a personality, because personalities don't endure, and institutions, like in the US, the Democrats and the Republicans, do. So I just wonder how you actually get in there. What do you do? Who do you meet with? And normally with these things, you start with someone you sort of know on the outside and try and get closer and closer. Very difficult to do for Mcebisi Jonas. Be watching that very closely. We'll talk about gas. not emitting it. We'll talk about gas, proper gas, in just a moment. Also, of course, conversations tonight around what's happening on the rest of our continent. Talk about coffee and Kenya. And a little later, don't forget, Warren Ingram, how you protect and grow your money in such a difficult time. And things are moving so quickly at the moment. Good to hear from you as always. 011 8830 702 021 446 0567. And of course, voice notes this evening on 072 702 1702.
702. Stephen is on the Money Show.
6 to 8 p.m.
We're reporting this week that Sasol now trying to find a way to get around the consequences of the looming gas shortage. Essentially, the gas that we receive usually comes from Mozambique. It's running out. By the end of 2028, those gas fields will be finished. The entire industry, or the entire part of our economy that rests on gas, will not be able to function. I mean, the consequences will be massive. All sorts of institutions and in parts of industry that use gas suddenly won't have the supplies available. It does seem that Sasol is trying to work around that. Chris Yelland is the Managing Director at EE Business Intelligence. He's been looking at this. Chris, good evening. As I understand it, the idea is to use what's called a synthetic gas. It's called methane-rich gas, so that would replace the gas we currently use. What kind of substance is methane-rich gas?
Well, it's a synthetic gas based on methane, which is already produced at Sasol in Secunda, and is already piped through the Lily pipeline from Secunda to industry in KwaZulu-Natal, in Richards Bay, in Durban. So there's nothing new about methane-rich gas. It's already a product of Sasol in Secunda. But the industry in Gauteng and in Mpumalanga uses surplus gas that Sasol brings in from its Pande Temane gas fields in southern Mozambique to Secunda. This gas is used for three purposes. Number one, it's used in Sasol's process itself. Number two, it's used for power generation within Sasol in the open cycle gas turbine. And any surplus gas is sold to industry in Mpumalanga and in Gauteng, and then it produces this methane-rich gas, which is piped down to industry in KwaZulu-Natal. Industry in Gauteng, Mpumalanga, and KZN all uses gas that ultimately comes from Sasol and Secunda, either its own internal process producing methane-rich gas or imported natural gas from Mozambique.
Okay, so methane-rich gas and imported natural gas, are they exactly the same thing? Could I take some methane-rich gas and put it in my gas heater?
Yeah, you probably could, yes. They're not exactly the same thing, but they are similar. And I'm not a technical specialist about the chemistry of the two different gases, but certainly industry in KwaZulu-Natal has no problem in using methane-rich gas, and I think it could use natural gas just as easily. There are, I'm sure, some technicalities that need to be addressed if one is switching from one gas to another. It could be to do with the pressures in the pipeline, the densities of the gas, the volumes that are transmitted, the flow measuring and metering equipment might have to be adjusted to cater for the different gases. But in principle, I don't think these are problems that are insurmountable.
So it would be a question of increasing production. Would that be difficult to do? I mean, is it more expensive than getting the gas from Mozambique?
Well, from what I understand from Sasol is that it would mean displacing some other products that Sasol produce, chemical products and others. And yes, it would come at a significant increase in cost because it's replacing other opportunities. So it's a kind of an opportunity cost. Lost revenue on one product would have to be recovered from this product. And therein lies a particular problem because right now Sasol does produce methane-rich gas, and it's this gas, or all gas, piped gas, is regulated by NERSA, and the gas that it produces supplied to KwaZulu-Natal is at a certain price. But if it's going to produce this other gas for Mpumalanga and at Gauteng, displacing other Sasol products, Sasol would want a much higher price for this. And this would mean it has to go to the regulator NERSA and explain to them, why there should be a different regulated price for this methane-rich gas, which is produced by the same process in the same factory. Why there should now be a much increased price for customers in Mpumalanga and Gauteng based on the lost opportunity costs of doing it for other products.
God, I wish them luck with that argument. I mean, already gas pricing is very controversial. What I don't get is that for the last, call it 2 years or 18 months, we've been talking about a gas cliff, what's going to happen, disaster, etc. Why is it taken so long to come up with this workaround if we're already producing it? I mean, was the cost of it going to be prohibitive? Did I just miss it?
Yeah, look, the gas industry, I think, suffers from very, very poor planning. The gas cliff has been talked about for more than a decade. It's well understood that the gas from Mozambique, the natural gas from Pandetumane, is coming to the end of life and that something has to be done about it. And finally, after knowing this problem for years, industry has known it, Sasol has known it, everybody's known it. Sasol finally said, okay, by June 2026, they will not have any more surplus gas to sell to industry. That created, a real crisis. And a lot of pressure was brought to bear on Sasol, to extend this deadline from June 2026 to June 2028, which it did. It had to, explore a bit more gas, drill a few more holes in the ground and do what is necessary at increased cost to extend the life. But ultimately, it's coming to an end. Now, when people have realized that actually this June 2028 is going to also produce a gas cliff because the alternative of liquefied natural gas, imported liquefied natural gas, is going to take longer, probably up to 2030 to actually become effective. And so we're going to have a 2-year gap. That would have been a disaster for the South African industry that relies on natural gas. So a lot of pressure has now been brought to bear, and people have come up with this new idea of using methane-rich gas at extra cost. Okay, the cost will be significantly higher, but it will probably be on a parity with imported liquefied natural gas. So ultimately, if industry was going to use liquefied natural gas at a much higher price, it could just as well use methane-rich gas at a much higher price too. But there are these regulatory issues, and there are some technical issues that need to be addressed. I don't think it's beyond us, and certainly in light of the crisis, I think it not only can be done, but it must be done.
I know there's a lot more exploration than there used to be. Well, there's supposed to be more exploration, Chris. I mean, it goes back and forth a little bit. Is there a risk to the industry, and would this be one of Sasol's problems that, okay, we will invest in this, we will do this for Gauteng and Mpumalanga, we'll avoid the cliff, and then someone goes and discovers a massive set of natural gas somewhere else, which is cheaper than the methane-rich gas, and then who knows what happens after that?
Look, there's nothing that can be done in terms of local discoveries of gas before 2030. In fact, probably more like 2035. So, yes, there could be discoveries, and there are discoveries being made, for example, on the west coast in what is called the Orange River Basin. There are also discoveries that have been made, off the Southern Cape Coast, the so-called Bulpada and Luiperd, gas fields. But again, there's a lot of risks associated with these things. And just because one's made some discoveries doesn't mean to say it will eventually turn into a commercially available product in 5-10 years' time. This is a risky business, and the South African industry, the ones that rely on natural gas, are looking for solutions in the next 2 to 4 years. So there is nothing in terms of new discoveries that is going to come to light and produce product in the next 5 years, certainly to 2030.
Chris Yeland, I really appreciate the time. Thank you so much. Managing Director at EE Business Intelligence. So much going on in the gas industry. And I mean, it's never been explained to me why there was such delay. Everyone's known about this for such a long time. Chris Yeland, thank you.
The Money Show.
The Africa Business Report.
Dr. Rotendo Ndungi is founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. Rotendo, good to talk to you again. So many people, of course, talking about the market volatility. African bonds tumbled. That had a big impact on Angola.
Good evening to you, Steve. Yes, and indeed, Angola, as we know, 30% of its GDP depends on oil, and 95% of its exports are oil related. So a big reliance on oil. It's recently just injected about $200 million to shore up a loan from JP Morgan. And this is related to a $2 billion debt that was affected with regards to the market volatility and what's happening globally, obviously due to the global recession. And as prices change, I mean, at the moment, I think the price per barrel has dropped to about $60 per barrel. So quite a significant impact there. I think also related to this, Stephen, is that the bonds market from an Angola perspective, we've also dropped from about 100 cents on the dollar to a low as 85 cents, which is a 15% drop. So quite a significant impact on Angola. And it just talks to the whole discussion around why it's quite key for countries to diversify their economies, especially those that rely on oil, especially with where the world is going. Absolutely crucial to have that diversity and options. But at the moment, that's one of the knocks that Angola is taking because of the turmoil that's on the market.
I presume this is having impact on other countries too. I mean, people might need IMF bailouts in some cases.
No, it's true. I mean, another country that's impacted similarly is also Gabon, that we've also seen. And if you recall last week, Stephen, we talked about Nigeria and what their Reserve Bank had to do in terms of injecting liquidity into the economy with regards to the exchange rate that has also been affected with regards to the tariff and the volatile market. So I think it's gonna be much more of the same in the coming months, and until obviously the stability in the US, in whatever form or shape that is, Stephen. But ultimately, a lot of governments, reserve banks, economists for the government departments will be on their toes as they adapt to the volatile markets.
And then, obviously, we've been talking so much about the price of coffee. The price of coffee is unbelievable at the moment, mainly because of the weather issues in Brazil. What's happening in Kenya? And they have a very strong coffee industry, or they did.
That's a very valid point you bring, Stephen. I mean, right now, the price of coffee is probably about $370 per 60 kg, and it's gone up by about 300% from 2020, where it was like $125. But Kenya, which used to be quite an active player on the coffee market, has actually seen its volumes of production go down. So just to add some stats to that, Stephen, around 1998, it dropped from, it was producing about 128,000 metric tons of coffee, and it's dropped down to about 49,000. That's more than a 50% drop since 1998, 1987. And a large part of this is because farmers begin to sell a lot of their land. And remember that in Kenya, 70% of the coffee produced comes from smallholder farmers. And a lot of these people have had land that they've had, but they're selling it to developers or they're going to alternative crops. Just to give you another stat there, in 1990, the land acreage for coffee was 170,000. In 2020, it's dropped down to about 119,000. So that's a 30% drop. And the specific variety of coffee which is in demand globally is Arabica. So it's a double loss here. Obviously, from a productivity perspective, Kenya is losing out on a big market. I did highlight in this same show again some months ago, Stephen, that the leading exporter in East Africa, in Africa, of coffee at the moment is actually their neighbor, Uganda. Ethiopia produces more, but it also consumes a lot internally. But overall, when you look at the matrix from a Kenyan perspective, everything is going down. And when you look at some of the reasons, besides just obviously selling land and acreage dropping, I think there's a big challenge is you've got a large population of smallholder farms that are producing coffee but are not able to scale. And it's either using climate smart technology or technology generally, which is also a bit of a strange thing because you and I know that Kenya has invested a lot of technology. We know the M-Pesa story, and there are a lot of positive stories in terms of investment and growth that happens in terms of technology. So why they're not leveraging off this is quite a strange thing. But ultimately, at a time when they should be riding the wave, of the demand for the Arabica coffee in Kenya, their volumes have gone down, and their focus from a productivity perspective has also gone down.
Yeah, no, I mean, they're such a big thing they're losing. And then conversations around infrastructure spend. And I see that, some people are suggesting that even though the US has cut aid, there still will be investment in infrastructure.
So that's obviously USAID, one of the key sectors that it used to, or three key sectors that the USAID investment, albeit aid that was focused in Africa, was education, healthcare, and infrastructure, a significant amount. We know, I think in South Africa, it was like $500 million, and it's quite spread across the continent, with leading countries like Nigeria and Ethiopia also feeling the impact. But again, it just talks in terms of the dynamics of the continent. Other guys are stepping up. And one company, I didn't know much of them until I actually read this article earlier on today, Stephen, was that the Private Infrastructure Development Group, called the PIDG, which is funded by 7 European countries, so the UK, Netherlands, Switzerland, Australia, Sweden, Canada, and Germany, have been active on the African continent from 2002 and have invested over $40 billion on projects. 26% of this of this funding has come from the private sector. 70% of these projects are in Africa, and 30% of what they've also invested is sitting in Asia. But a large portion of this investment is coming to Africa, and there's a specific focus. They're seeing the opportunity because it's not just aid company money that's going there without any return on investment. They're seeing a lot of return on investments, a big focus on renewables, with the key drivers being solar, hydro, and wind, that's attracting the investment. And they're also targeting the smaller infrastructure projects around energy. And the reason for that is that the bigger banks or the bigger institutes are a bit more risk averse, but they've got the agility, they've got the risk appetite. So it's exciting stuff, Stephen. And I think it just talks again that we might have this turmoil. There might be these other opportunities that are going away, but other opportunities are coming up. And just to finalize on this point, Stephen, as well, this company has invested $37 million in technical support to ensure the infrastructure that's been put in place has actually got the right skills to support and sustain it. So a great story to hear with the dilemma of what's happening around in terms of sustainable infrastructure going forward.
And then in Djibouti, a carrier-neutral data center service is coming.
Yeah, so Djibouti is a very small country. It's one of those unique countries. I mean, I think the population there, Stephen, is probably about plus or minus 1 million people, but its GDP year-on-year growth is about 7%, which is very high for Africa. One thing about Djibouti that's very unique, it probably houses 7 or 8 of the top military countries in the world. So China is there, France is there. But to cut a long story short, they've invested in a carrier-neutral data center, which is just a data center that allows companies to be flexible in terms of their service providers. They've invested millions, and the company that is doing is actually from Netherlands, called Pace. And the reason they've chosen Djibouti because a lot of the sea cables terminate there in terms of under the sea. There's a big connection drive to supply the rest of the Asian and the European market, and they're also wanting to offer it as a service. So a population of less than 1 million, but huge investments, and they're targeting telcos, finance, and tech companies with regards to the technology that they want to offer, and they're offering it at a very competitive rate.
And then in Gambia, the AFDB, their executive director is visiting that big project there.
Gambia, again, a very small country, but they've just invested in a number of key projects over the last sort of 5 or 10 years, about $225 million. Gambia, again, a very small company, GDP of $2 billion and 5% year-on-year growth. But again, this specific bridge that's between Gambia and Senegal, because they're surrounded by Senegal and the rest of their coastal areas into the Atlantic. But it's a small country, but things like this stimulate industrialization, stimulate growth, stimulate economic investments, which obviously contributes to the productivity of the country. Through AFDB, which has been a major funder, partnered up with the EU, they've looked at also empowering women initiatives, as well as transport, agriculture, and energy. So a lot of exciting stuff that's happening there. It's a small country, but it's also stepping up in terms of contributing, in terms of making an impact on the African continent in a positive way through these kind of deals.
Dr. Rutendo Hundungi, thank you so much. Founding Director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. Lots going on, of course, on our continent, as always. You're with The Money Show, just gone 7:30.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. If you take a look around what's been going on for the last couple of weeks, well, you can imagine what tonight's topic about. Basically, how to protect your money, how to grow your money when the politicians are, let me be polite, behaving badly. Well, Warren, good evening. I mean, you've chosen a good topic. It's been just the last few weeks have just been utterly insane.
They have, and it's almost, irrespective of what country you look at, we see politicians seemingly doing their best to act against our interests as citizens and as investors rather than for our interests. And you're right, Stephen. I think it's caused enormous ructions right around the world, and people are worried from a valuation perspective. People are worried about the value of their investments, and they're worried about whether they'll be able to retire, or if they are retired, will their retirement money recover? And then business people are phenomenally, concerned about whether they'll be able to sell goods. Will they be able to get stock? Will they be able to pay a reasonable price for that stock? And will they be able to sell their stock to their clients at a fair price? And so we're it would be an exaggeration to say we're at peak uncertainty, but gee, we can't be far away from it.
Do we need to sort of prepare ourselves for a bit more? I mean, my sense of things, both here and abroad, is that we're not quite through it yet. In fact, I think the South Africa situation is easier to predict than what's happening in America right now.
Well, I'm going to leave the South Africa one to you, because what I've learned about politicians everywhere is that I can't forecast them and I can't predict what they're going to do. All I can predict is that they usually disappoint me. So I think if we look at the States, we have to make peace with the fact that Donald Trump is going to keep us on our toes for the rest of his presidency. I don't see a time where he's going to want a nice, smooth, predictable lay of the land. I think he enjoys the volatility that he creates, and certainly if it's a tactic, he backs himself to deal with that volatility and the uncertainty better than everyone around him, and especially the people that he's negotiating with, if negotiating is the right word. So, I just want to give one context to one thing, and that's, we when we're talking about the times of volatile, we're in a situation where, we get 3 days in a row where the American market goes down, and it ends up being kind of the steepest 3 or 4 day loss in the Standard & Poor's history. In other words, the S&P 500's history. And straight after that, because of a tweet or whatever you'd call that Truth Social post, where Trump says, maybe we'll back off on the tariffs for 90 days, we suddenly see the American stock market jump 9.5% in a single day. Now, that is one of the very best days in recorded history. So you in the space of less than a week, you've got a period of one of the worst downtrends in recorded history, and then suddenly one of the very best days in history. That kind of volatility is really astounding, and I think, if you're feeling unsettled as an investor, understand that this is we may not stay at these levels of uncertainty or volatility for the rest of Trump's term, but certainly that it's here to stay is a reality. And I think we can do something about that. We can't control the politicians. We can't do anything to protect our businesses or our investments when we don't know exactly what's going to happen. But what we can do is psychologically prepare ourselves for this. If it's a bit like running a marathon, don't start a marathon thinking that it's only 100 meters long. You're going to be very disappointed after the second 100 meters. But if you're in a marathon of uncertainty and noise and volatility, you can prepare yourself for that, and I think it helps you to take a much longer term focus if you say, okay, this is the norm. we're not going to get stability. I can't plan my investments or my business strategies around hoping that in 3 months' time everything's going to calm down. If you turn it on its head to say this is the norm, it's going to be crazy, it's going to be volatile, then you can start to make much better, more sensible decisions that are long-term and forward-looking, and don't worry too much about the day-to-day moves, because you just have to know, I think probably this time a week ago, we were looking at the Rand, getting very close to 20 to the dollar, and now it's getting closer to 1850 to the Rand. You just have to know we're in this now. This is our normal for a while.
Can you use market drops to make some purchases? And that's been one of the sort of features of the last few days, as you've seen companies like Capitec or ShopRite suddenly becoming more affordable.
I think you should do that. I would urge a little bit of caution. So, if we see a company drop in value alongside a bunch of other businesses, then that's a very good sign. That tells you that it might be a good buying time. But if a company drops in isolation and its peers don't, then just be very, very careful there. But I think where we are now, when the entire market falls and it has a radical fall, and you've got capital available, then certainly that would be a time to get a little bit more aggressive with the way that you invest. And just to understand that, I'm not saying go and take money out of your home loan and sell your car and invest that in the hopes that you're going to get another 9.5% day. I'm saying that you still have to have a long-term focus. But if you've got lazy capital that's lying around, that's been sitting in cash and doesn't have a purpose, then this is a good time to start buying in, and maybe just be careful of putting it all in at once. Don't be afraid of phasing it in, feeding it in over a month or 3, because I think when markets are doing this, feeding the money in over a 3-month period, when there has been a big drop, it might just give you the opportunity to have 2 or 3 bites at the apple.
011 883 0702 021 446 0567. Your questions for Warren Ingram tonight on personal finance, and talking, of course, about how to manage your money in such a difficult time. So if unpredictability is now predictable, what does that then mean for us? I mean, how do we kind of survive that time, Warren?
Let's swing back to the South African political situation for a second. I mean, understanding that, lots of us, I think maybe some of the political parties themselves hadn't really considered a government of national unity that didn't include the DA, didn't include the EFF or the MK, and that was put on the table all of a sudden, and so just understanding that when you're in a state of flux like we are, we're relatively. I know the politicians want us to not say coalition, but that's really what it is, and when we are in a coalition environment, we need to make peace with that. Coalitions are very rarely stable and predictable. So understanding that when you're looking at the South African context, make peace with the fact that it's going to be unstable, and that there will be outcomes that you simply cannot predict. I wouldn't have said to you that there could be a government of national unity without MK, EFF, and the DA. It just wouldn't have occurred to me, frankly. And if that is a reality, I don't know what the outcome will be. I'm not convinced that's the world's worst outcome for South Africa right now. It creates further unpredictability, further instability, but maybe some of these unpredictable outcomes will end up working in our favor. And I do think that we need to know that if there is instability, it does create opportunities, because other people around you are not going to be comfortable with that unpredictability, and so they will often sell assets at ridiculously low prices simply because they want some certainty. They want to lock in some value somewhere, and very often we get to this stage of stock market or even property markets where we talk about capitulation. People just give up and believe nothing will ever get better again. And if you're comfortable that that things are unpredictable and that you're happy to deal with that that sort of unpredictable stage, then what it allows you to do is to buy assets when everyone else is selling in panic, and what you really then need to do is be comfortable to hold those assets for a period of time until we come out on the other side of this, and that could be in 3 months, 3 years, or 6 years, who knows? But if you're making peace with two things: one, that it's going to be noisy and loud, and social media will be shrill, and number two, that you shouldn't be hoping for stability and planning for stability. I think it gives you a real advantage to cope when others are simply not going to cope.
I mean, this is all about also just, being able to basically hold on. Markets, do they recover more quickly than you think they will? I think it's common to sort of think it's disaster, it's Armageddon when things go wrong. And a week later, it's almost like it didn't happen. Well, certainly in this case.
and I think it's going to repeat itself like the proverbial broken record. I think we are in a situation where there is some hysteria. I think certainly if I look at the American media, they are. I think either they are hysterical or they're trying to create hysteria that to get more clicks, and in a situation like that. That sort of hysteria is unsettling, and understanding that if you make peace with the fact that it's going to be like that, and number two, that you can't sit on the sidelines waiting for everything to get better and waiting for things to recover. You don't know what that signal is. You don't know what the trigger will be for markets to decide that today is the day where we think we're over the worst and we're on our way to better days. It could be something entirely unpredicted. There could be a health event for an elderly president. It could be that suddenly the bond market reminds the American president that he's not the biggest force in the world. It's actually the bond market, and he has to learn humility. And if that happens and markets become convinced that he's learned discipline, that could be the time when we see a really quick recovery in markets. And there is no way that any investor will get that sort of a prediction right, Stephen. So I think people who sit on the sidelines and just wait for the world to get better, they're going to, I think, lose out on a very good recovery as and when it happens.
Your question for Warren Ingram this evening, the co-founder of Galileo Capital, on 011-883-0702 and 021-446-0567. Janet's been in touch with the question. She says, Warren, hi, I've read about the 4% rule in retirement planning. What is it, and does it apply to everyone? We'll have an answer for you in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, a certified financial planner at Galileo Capital. And Janet's question, Warren, was about the 4% rule in retirement planning. Does it apply to everyone? What is it? It's an interesting question from Janet. What is the 4% rule?
It's one of my very favorite things in the world of retirement, Stephen, because it is a rule of thumb. So like in all rules of thumb, it won't necessarily apply perfectly to everybody, but it's amazing how often it works. And the theory is that if you get to retirement and you've got your investment money and you say, I'm going to invest it in a just a typical balanced portfolio. So if we look at the balanced unit trusts in South Africa, they're pretty much the vehicles that represent how retirement money is invested and has been invested for the last 30 years. And over that time, they've generated a return somewhere around 10 or 11% a year over 30, 40 years. And 30, 40 years is the duration of most people's retired lives. And so if you're going to get to the point when you retire and you've got this money invested and you say, I'm just going to follow a very typical balanced unit trust, then the reality is you can draw 4% a year from that capital that you've got invested in those balanced unit trusts. And it doesn't matter if you own those unit trusts via your living annuity or just normal straightforward unit trusts. Either way, it doesn't matter. But drawing 4% a year from those investments means that you're leaving behind somewhere around 5 or 6% a year growth. And that tends to tie up with our cost of living. It tends to tie up with the inflation rate. So the 4% rule says that if you want to know whether you've got enough, take your retirement amount of investment assets, work out what 4% a year is, and then divide that by 12 just so that you get it to a monthly amount. And that's the amount of income that you can sustainably draw from your investments and still be sure that every year you'll be able to keep pace with the changes in cost of living. So it's a very nice rule of thumb for people that maybe are getting close to retirement, or people that are 10 or 15 years away and want to figure out, how much do I need to get there? Because just to help people with the maths, if you're saying, I know what my expenses are on a normal year, and it doesn't include kids' education and paying off the bond, because all of that will be done by the time I retire, you can take your annual expenses and multiply that by 25. It's exactly the same as using the 4% rule. So it allows people that are before retirement to work out how much capital they need, and people that are close to retirement, if you're drawing 4% a year, you're very sure that over the next 30 years, you'll have enough money, you'll be able to increase your income every year with the inflation rate, and still possibly leave some money behind if you manage to make it to the late 90s or even the early hundreds in age.
Okay, so that's quite a simple rule of thumb. I see what you mean. When we talk about, the main theme, of course, talking about the sort of unpredictability that we've seen, the uncertainty. There have been some stocks or markets that have fallen by 15%. You look at some share prices over the last little while, and it's very scary to look at that. How should you behave? How should you react when you see something like that?
I think that the headlines are scary, and I know the one that kind of attracted a lot of noise around the world was Apple, and talking about that, there was in a very short space of time, Apple lost something like $1 trillion in its total value because of the tariffs that Trump was going to impose. And $1 trillion is a heck of a lot of money. I just think it's not an amount that we can really contemplate, and that happened in a very short space of time. My suggestion when you see something like that is just take a moment to zoom out. Just go on the internet and work out, ask the question. There's so many good AI engines now that can help you with this, to say, what has Apple's share price done over the last 12 months? And you'll be surprised that, over a year, including all the big drops that we've just seen in the last little while, that Apple would have been up more than 12% over a year. So if someone's, screaming at you that it's lost 15% over the last few weeks, well, that sounds scary. That sounds like something you should really be paying attention to. But if someone says, hang on, actually, including that drop, it's still up 12%, then it gives you a bit more context. And I think making sensible long-term decisions requires context. It requires you to zoom out. What we need to know is Apple had a mighty run in its share price, through last year and right at the start of this year. So for it to have lost 15% in a 2-week period, it sounds dramatic, but actually, when you zoom out over 1 year and then over 2 or 3 years, you realize that Apple's done incredibly well for shareholders, even with that loss. And I think if you look at a stock market drop, when a share price drops for a very big company, that's a little bit traumatic for the shareholders and possibly for some of the staff who own shares. But at the same time, understand some fundamentals. Apple's sitting on more than R1 trillion of cash in its bank accounts. Sure. It can go for a very long time without selling much and still be okay. And in fact, those execs at Apple will probably use these kinds of drops to buy back some of their shares and execute rational behavior. So I think our job is to give ourselves context, zoom out and say, this stuff looks bad over a short period of time. What's it like over a year? What's it like over 5 years? Why the panic? And usually the panic is not that warranted.
R1 trillion in cash, an amazing thing for a company to have sitting in reserve. We can't predict what's going to happen. So, okay, that's very uncertain. We want to be able to predict. We get messages all the time. If we know it's going to be like this for a year, let's just say a year for argument's sake, what do we do? Do we sit tight and do very little?
I think that would be the very best thing we could do. If you're correctly invested and you've got a nice long-term portfolio, then what happens over a 3 or 6 or 12-month period, it's pretty relevant. If you're looking at a 10 or 20-year view, then what happens now is not going to be much of an event when you look back in 10 years' time. And I mean, to give you an idea, 2008, I mean, you and I were alive and working and functioning at that time, and 2008 was a catastrophic time in markets. There was a real possibility that the whole financial system in the West would fall over. We look back at it now, and we're all alive. We may have got a few grey hairs. Our investments have done okay since then. So what you're in now and what we're living with right now is traumatic, but actually not such a big event. And I think it's probably hyped up a bit more with things like WhatsApp groups. And it frustrates me so much when I get a forwarded WhatsApp message from somebody saying, I've got this from a friend and they're very clever, and then you look at it and it says it's been forwarded many times. Well, the very clever friend probably just forwarded it on and didn't pay much attention. So when you're getting WhatsApp messages from your mates, you might think they're very clever, and they might well be, but it doesn't mean that they've paid much attention. They're just forwarding on garbage, and most of the time when you realize who's creating the garbage, it's some 13-year-old sitting in their bedroom trying to get a bit of attention from somewhere, and now you're making long-term investment decisions based on that. It's really not smart. So if you want to understand how markets work, read a book about markets. Don't read a WhatsApp message. It's not going to help you. You need to avoid the panic and have a real long-term focus, and maybe just shut down the WhatsApp groups for a little while if you can't stop reading them.
Warren Ingram, thank you so much. Co-founder at Galileo Capital and, of course, a certified financial planner.
The Money Show.